The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending the 12th of January 2018. First article up, Zero Hedge. Has China been quietly selling U.S. Treasury? Here's the answer. I should say treasuries. The answer is yes, they have. And we've known this for quite some time, that the BRICS are basically putting up a barrier against the U.S. dollar hegemony, the reserve currency, and with the Asian Infrastructure Investment Bank and the consortium of those countries, they certainly have started to move away from the dollar and been doing so for some time, and rather quietly, I might add. But this whole idea of the debt markets being the most important market is absolutely 100% true, and the one area that everyone needs to focus on. The yield curve has been flattening a great deal, as most of you know, which has always portended the fact that a recession was coming. And I believe that's the case here. A lot of people think that increasing interest rates is very negative for gold. That is not true until the interest rates are actually positive relative to the inflation rate. If you see the inflation rate in its true perspective, using shadow stats by John Williams, it's probably around 6%. Let's just be conservative and say it's only 4 or 5%. That would mean you would need like a 6% on the 30-year bond to have a 2% real rate of return. You're not there. We're still at real rates that are negative because inflation is greater than the yield on the T-bill, the T-note, or the T-bond. That is a fact. And just to add some more to this, this is from a more mainstream article, although I think Zero Hedge is probably number one go-to source for many of us. From CNBC, more mainstream bonds. China just reminded the United States that Beijing is its banker. Just basically more of the same. In other words, they're trimming their treasury holdings. China delivered a statement soothing those worries on Thursday. China is the biggest holder of U.S. treasuries, and the U.S. government uses treasuries to finance itself. Well, the U.S. government uses the Federal Reserve, which is a private bank, to finance itself. It doesn't. Government doesn't fund itself. The government borrows money on behalf of the citizens without them asking about it to fund what they do with it. So anyway, to go further in the article, U.S. bonds sold off Wednesday, and that's been the point. Markets took a hit during a Bloomberg News report that cited unnamed sources as saying that officials in Beijing have recommended China, the largest holder of U.S. treasuries, to slow or even halt its purchases of that debt. So this debt thing is, again, the most important, and it looks like we're getting more and more pressure here. And I'll just keep reporting on this because everything bases the debt markets comes from that. In other words, interest rates, currencies, flows into and out of certain asset classes, and everything's built on trust. Bonds are the most trusted vehicle out there, when at this point in time, they really should be mistrusted by almost everybody. Obviously, the BRICS mistrust the U.S. treasuries because they're doing their best to kind of slide away from them slowly and surely so they don't disrupt the entire market. That would be shooting themselves in the foot. But whether or not this whole thing can hold together for the next 10 or 20 years, I really doubt it. And this is an article I picked up from Silver Doctors. The title is Move Over, Fort Knox. Here's an actual look inside Russia's gold vaults at their gold reserves. I know most of you are on the podcast, so you're not seeing these pictures, but I'm going to scroll kind of slowly because I do put this up on our YouTube channel, Silver Guru on YouTube. And you can just see all of this gold that is stacked up in these rows. I've actually had the privilege, I guess you could say, of being in a few of these vaults in the world in different locations. And it's really impressive, for me anyway, when you walk through this much area of just these stacks and stacks of gold. And what these pictures and article, which is very brief, point out is that, wow, Fort Knox, if you've got all this gold, then, why can't we see it? Obviously, this picture's some silver. I've been in the Delaware Depository, and John Potts took time out of his day to basically walk me around the entire facility, which, as most of you know, the Delaware Depository is one of the COMEX-approved warehouses for precious metals. So I'll move on to the next article. I know that I put up my article on our social media, our YouTube, also on the blog at the Morgan Report. By the way, just let me pause it for a second. You, meaning the listeners of this podcast, might consider looking at the morganreport.com website, maybe on a weekly basis, because I do add to the blog at least once a week, but usually more like 2 or 3 times a week. And it's something that I feel is extremely important. And of course, on the article, the only public article that I've written about Bitcoin, we've been following the blockchain phenomena in the paid version of the Morgan Report for a few months now, and we plan to continue that. But regardless, this one kind of made me laugh because I've always been pro honest money. I still think that the premise of the blockchain so far from what I'm seeing is a fiat system, unbacked. And I've heard all the arguments, so you can just leave your comments to yourselves, or if you need to tell me for the 70th time how great it is, go ahead. You can also save some time and read my two bits about Bitcoin. Anyway, moving on. The article really made me laugh. It says the North American Bitcoin Conference is no longer accepting Bitcoin payments for tickets. It will take place in Miami next week. No longer allowing people to pay for tickets with cryptocurrencies due to, quote, network congestion and manual processing, end quote, issues. Now, this is something I pointed out about the transaction time taking more and more and more time as Bitcoin progressed because of the math of the formula, in other words, the way it's structured. I also pointed out that not only would it take more time to clear a transaction, but it would also cost more as far as the amount of that you pay a bank, for example, to process a Visa card, for example. So this has been something that many Bitcoin proponents have said, there's basically going to move all this money very quickly and there's basically zero cost to it. That was true. That's the past. Now is now. And it actually costs a fairly substantial percentage. And lastly, one of the concerns that I have expressed and many others is that as the system progresses, talking Bitcoin specifically, that we will see more and more electricity is used to quote-unquote mine a Bitcoin or really a block. And that's something that is very, very concerning to some of us. So moving on, I want to be clear that I'm not against the blockchain. I think the technology is here to stay. I'm not against cryptos per se. I am against fiat in all forms. I will state that. And to keep away from being to make sure everyone's certain where I'm at. I have decided to go ahead and participate in what I'll call a test market to do our best to pair a cryptocurrency or blockchain methodology with silver. So it would be, in my view, a pairing of this new technology that's been proven, obviously, to work, and a metal that's been proven to hold its value over a longer period of time. And whether or not it works remains to be determined. We've already put that out to our members. They have access to the website, and they have the ability to enter in on an early stage. Remember, it has not come out yet. So that's something that's high risk, very high risk. And I'm not recommending anyone do it. I've done it, but that's my free choice. If you're interested in it, I'd suggest you get on our free email list. The free list is available at themorganreport.com. Just give us your email, first name, and verify that you are you, and we will keep you abreast in the public domain as things move toward that date where it finally launches. So I'm getting close to my 10 mark. I try to keep these at 15 minutes or less. I'll start talking to precious metals. Some of the highlights from the Silver Institute, Thomson Reuters, GFMS, with an interim look at the silver market. Now, this will be the 2017 study or analysis on the silver market. It's 2018 early on, second week, and this study will not come out officially until probably May of 2018, so 4 or 5 months from now. However, they've kind of given us a peek of some of the highlights of that study when it does come out. So this is as of the end of November last year, but the silver price averaged about $17.13 per ounce, and the year before it was $17.23. So basically no move at that point in time. However, here's something kind of interesting. Total silver supply is forecast to remain flat in 2017, with roughly 1 billion ounces. It's been hanging in that rough number for quite some time. Global mine output is set to reach 870 million ounces this year, meaning 2017, representing a year-to-year drop-off of about 2%. So, I love Steve St. Angelo. We are friends. We don't agree on every single thing about everything, but nonetheless, he's pointed out some of these major situations where there's been a loss at silver mining. And those specific examples, he's absolutely correct. I hardly ever argue a number unless it's wrong. But the point I'm making is that if you factor in all mines everywhere around the world, what you're going to see is the drop-off is 2%. But 2% of a billion is still a pretty big number. Moving on, total physical demand is forecast to drop 5% last year to a total of 976 million ounces, led by a sharp fall in retail investment. And I looked at their projection, and basically the last 5 years we've been looking at round numbers, about 200 million ounces offtake for investment reasons. And according to their preliminary number, it's roughly half that. It's a little more than 100 million, but not much. So I was rather shocked at that, but they say it here in plain English. This is what they're looking at. Jewelry fabrication was expected to be within about a 1% of the previous year, and a modest year-to-year decline in industrial fabrication. And they talked about solar, alloys, and solders, and that global silver demand from the solar industry is forecast to increase. And that's true. Right now, as we know it, the amount of silver used for solar should be the highest ever in 2018 this year. So that's the silver side. Let me talk about gold for a moment. And lastly, this comment on gold. This is from BGM Group, Nick Barisheff. Nick and I go back years. He's been so nice and good to me. Over the years, I've almost always make a point when I'm in Toronto to take some time to go see him and visit him in his office or meet him downtown in a restaurant or something. So that's the personal part of it. He does an excellent job. He runs, as I said, BGM Group Incorporated in Toronto. And they have been doing this week in 3 minutes for a while now. And this is something that someone interested in the gold and silver market should really take the time. It's done by bullion manager Brandon White, and he does a great job. I don't watch every one, but I've watched several. They're always very good. So what this one is about is that the Superintendent of Financial Institutions says that the Basel III rules for banking stability will be applied to Canadian banks by 2019 and give gold bullion the highest status as a risk-free asset. Let me say that again. Give gold bullion the highest status as a risk-free asset. This White suggests may encourage purchases of gold as the everything bubble pops. So let me just reiterate and come all the way back to the beginning of this update or perspective. The perspective is that one of the most perceived risky markets out there is the gold market, which is not true. Gold doesn't change. An ounce of gold is an ounce of gold. The mass is the same anywhere in the universe, always and everywhere. That's a constant. What changes is the currency required to purchase said ounce. However, all currencies or fiat currencies have failed 100% of the time. And what's to say the dollar isn't failing as we speak? So the point being is that the bond market, perceived to be risk-free, is very, very high risk at this point in time. And gold, that is perceived to be very risky, is very stable. And this is kind of the upside-down world that we live in. So I suggest taking a look at this video. I'm going to call it quits here. I will be with you next week. I also, one more thing I'll add on, and you can turn off the video here. I will say that I'll be doing a mastermind this month with the CEO of our highest-rated, most speculative, highest return, we believe, stock that I've featured in a very long time. So anyone that is a full paid member of the Morgan Report on the Mastermind series will get that by the end of January. And I think I'm going to make it available for all members. So if you're considering a membership and you want to know a stock that I think can go up like a 10-bagger, read the disclaimer, or more. That would be this one. And again, we'll be interviewing the CEO on our Mastermind series this month in January. If you really want to get ahead of the game, you certainly should have your bullion physical paid for in a safe place that you can touch. But beyond that, if you really want to stay ahead of the game, you want the leverage in the mining equities, and you want to be able to time the market. And that's what we've done for quite some time, and we've been very successful. We get it right 100% of the time. No one does. And anyone tells you that they do, you better move on to some other newsletter writer, because no one gets it right 100% of the time. Our track record speaks for itself, and I know almost everybody in the industry. So that's it. Signing off. Wish you a happy new year. I'll be back next week.